So under finance, we're going to be looking at investments. So you putting money away so that it hopefully will earn interest, right? And you will gain. It basically, you earn money without really doing anything. It's just sitting there accumulating interest. Or loans, that's when you borrow money and that's where you pay interest. Okay? And so Albert Einstein, I have that quote there, which I think is very, very true. Something called compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. So it's basically saying if you don't understand how interest works, like a lot of people like to use credit cards and borrow money, and they don't know how much money they're paying in interest to the bank. That is all money you could save and actually have in your own pocket. And at the same time, the reason compound interest, let me just give you a quick diagram here. When you think of compound interest, I want you to think of a graph that looks like this, right? If you're comparing time and you're comparing how much money you have in a savings account or if you have it invested, the money doesn't just grow linear, it is exponential. So there's a part where it kind of goes flat, but then all of a sudden it explodes and grows really, really fast. So it's exponential growth. Can you write that down? I think this is coming back, by the way, exponential functions, but compound interest is exponential growth, also known as a snowball effect. So at the beginning, when you make a snowball, when you start small, it's like, oh, it's small, right? But then you keep rolling it in the snow, and all of a sudden it just gets bigger and bigger really fast, right? So same idea. Compound interest is exponential growth. If you put $100 away when you turn 18 and you leave it there till you're 67, you're going to be a millionaire. I'll show you that. You just have to find the right interest rate, right? It's not like it's not, but at the same time, it all means you put money away on a regular basis. Okay. Winning the lottery is not what you want to bank on. Okay. Let's go to page 4 at the top. Your page numbers are at the top right, by the way. I'm just going to talk about some of these concepts. It's vocabulary, and I encourage you to read through this to review if you need to have a more specific definition. So investment, obviously, it's the saving money for the intent of earning additional money for the future of some sort of goal that you set yourself. Then there's something called principal. Principal, when you invest, is the initial or the original amount. Okay? I will just highlight the initial or original amount. Interest, amount of money earned on an investment. Or it could be, when it comes to a loan, it's how much you will have paid to borrow that money. Interest rate, R, okay, is the rate at which an investment will increase. It is stated as a percentage per year or annum. It means the same thing, per year. Term, the term or the maturity is the contracted end date of a loan or investment. Okay, so when they talk about a 5-year term, it just means that this investment will be a 5-year investment or the loan will be a 5-year loan. That's it. Future value. I'm going to highlight future value here. Look at the letters that I assigned to it. Future value is known as A. Okay? It's the total accumulated value after maturity. Okay? Accumulated value. How much have you accumulated over time? In general, this is very important. I'm going to switch colors here. In general, A is the principal plus the interest. In short, A is equal to P plus I. Okay? Return on investment. The amount of money gained through an investment, also worded as the increase in value of an investment, can also be called interest. So I will just say amount of money gained. Can I say or lost? I think a lot of times our examples are going to assume that we're gaining, but we're not always gaining, especially if you're in the stock market. Has anybody followed the price of gold at all? Do you know what happened to the price of gold in the last 5 years? In the last 5 years, you almost tripled your money. Okay? You almost tripled. So if you bought an ounce of gold, do you know how much an ounce of gold is? It's a plate of gold about this big. It's not that big. An ounce of gold is now almost $6,500. And it was 4,000 or something 5 years ago. Okay? But the last 2 days, gold has gone down like crazy. Like it's lost hundreds of dollars per ounce. Okay? They always give the price per ounce. So sometimes you lose, right? But gold in the long run, if you look at it going back 100 years, and now, even though gold has gone down at times, it is still worth way more than what it was 50 years ago. Okay? So, but sometimes you lose. In the short term, you lose, but in the long term, you might still earn overall. Okay? So return in general is future value minus initial value. That's how you know how much you've earned. Rate of return, ROR. Okay? ROR. Anyways, the amount of money gained or lost expressed as a percentage. So they're related, but the amount of money gained or lost as a percentage. That's what rate of return is. Note, it is not necessarily dependent on the amount of time involved. So this is one that I would say you should have on your study sheet. As well as, may I go up here? I think this is going to come up again and again, but I would also box this one in. Annualized rate of return, I'm going to skip that one. That's something that I just brought in, but the province doesn't require you to do it. Annualized is really just like, let's say your rate of return is 80% over 4 years. 80% over 4 years. If it's annualized, like how much did you gain per year? It's just 80 divided by 4, it's 20%. And if you're scratching your head right now, we're not going to worry about that, okay? So just keep going. Whoa, more terms, right? Just the important things here. Risk, right? Risk is a big concept in this course. Risk is the possibility that investment will have a negative return, okay? A net loss rather than a gain. That's basically, I will highlight that one. In general, higher risk investments offer a greater return. Higher risk usually gives you higher return, but there's also a higher possibility of loss. So example would be cryptocurrency, right? Crypto has gone up like crazy, but it has also dropped like crazy, okay? Lower risk usually offers a lower return. So when you drive on the street, like even if you go down McPhillips, you see all these banks and those interest rates offered, they are really low interest rates. I'm not gonna lie, like 2%, 3% for savings. That isn't impressive at all, but it's also very low risk. You're not gonna lose your money. They're basically guaranteeing you that your money will gain the 2 or 3%, okay? So basically a savings account in the bank would be a low risk, low return kind of deal. I will switch colors here just to give it a little bit of a contrast. A portfolio is a collection of investments. A portfolio is a collection of different investments. And the idea when you invest is that you want to diversify. And you want to diversify to avoid putting all your eggs in one basket. So an example, I'll give you an example of someone's portfolio. You could have some money invested in gold. You could have some money invested in a savings account. Do you guys know what a TFSA is? Tax-free savings account, yes. You should open one as soon as you turn 18. In Canada, you can only start when you're 18. You can only put in about $5,000 a year. But that money, and I'll show you, if you put in, what's $5,000 a year? What's the equivalent per month approximately? 200. If you put $200 a month, that's $2,400, right? So if you put $400 a month away in a month, that's about $4,800 a year, correct? So if you put $400 away a year, you're gonna have millions down the road if you put it in an account that earns you enough interest. And I can show you that. I can give you the contact of a person that is a financial advisor that I deal with that actually has an 8%, 10% kind of interest rate return. But you can have millions by the time you retire, millions of dollars. And that's all tax-free if you put it in the tax-free savings account. If you don't have it in a tax-free savings account, you will pay taxes on anything that you've gained over the years. So let's say $400 a month, that's $5,000 a year. Over 10 years, let's say, that's $50,000 that you will have put in, right? Let's say your investment grew from the $50,000 to $500,000. The government is going to charge you taxes on the $450,000 that you've gained, which is insane. You're going to pay half of it probably into taxes. Okay, I will talk a little bit more about as we go through examples. I'll talk about that a bit more, but all I'm going to say is open up a tax-free savings account when you turn 18, okay? Do yourselves that favor and put money away. So you could be gold savings. You could have a stock market. You could have some money in the stock market, which is risky. But the idea is you put money in different investments. You don't put it all into one. You don't say, oh, I'm going to put my $100,000 all in gold. It's probably not smart to do that, right? And so diversify. So a portfolio is just a bunch of different investments that you hold. That's my portfolio, okay? It's almost like a folder with different assignments in it, right? Mutual funds, it's a managed investment. It's managed, but it is an actual portfolio itself. A mutual fund is a fund that it's a pool of funds collected from many investors. Okay? and it's being invested in securities such as stocks, bonds, market, or similar assets. So a mutual fund is basically a portfolio, but what's the difference between the two? That the mutual fund is managed by some firm or someone. They do it for you. You don't have to worry about like, oh, should I put some in gold? Should I put some in silver? Should I put some in TFSA? Should I put some money into real estate? Did you know that you can buy real estate, right? You can rent out a house. That's an investment. They do that for you, so you don't have to worry about it. Keep going. GIC, this is important. You need to know, this will come up. GIC is a guaranteed investment certificate. But here's the downside. I will write that down. Very safe. That is the plus. The plus is it's very safe. A guaranteed investment certificate is very safe, low risk. The downsides is lower returns, and it is locked in. So if you sign a GIC for 1, 2, 3, 4, 5, I have never seen a GIC for more than 5 years. But if you lock it in at 5 years, guess what? You can't touch it. Like once you put, it's like if I have 20 grand and I put it in there for that higher interest rate, you can't take it out. You can't add to it. It is it. That's it. You signed to lock it up for 5 years. So that's the downside. Low returns, and it's locked in. Bonds, I'm not going to talk about. No longer offered. I thought I wrote this down. Omit. We no longer have bonds, but U.S. still has bonds. You know what a bond is? You buy some debt off of the government. So let's say the government's like, oh shoot, like we owe $100 million. We did all these projects. We don't have money. You basically give the government your money, and they give you back more at the end of that term. They're actually borrowing money from you, which is way cheaper than them having to go to a different country and asking like another country to borrow you money for this project. Okay? By the way, Switzerland, Norway, there's a bunch of European countries even that borrow money to us, to the US, it's basically a form of investment because they get it back with interest, right? So just so you understand that. TFSA, there it is. Tax-free savings account. I'm just gonna ask you to highlight that. Tax-free savings account. TFSA is a non-taxable investment. Keep going. There's not much to highlight there. I wonder if I feel like you need to graduate and know a little bit more than the bare minimum. I'm just going to say this. You are not taxed on any gains. You're not taxed on any gains. Anything that you've gained, the growth that happens, you're not taxed on it. So that is huge. Keep going. Sorry, I need to work on my camera skills. I seem to have forgotten how to do the camera over the last week. Okay, keep going. I will skip the market-based investments. I will talk about dividends. real quick here. These are payments made by businesses or shareholders of businesses. Dividends are paid annually and depend on the profits made by the business. You don't need to know this for a test or exam, by the way. But sometimes when you invest in the stock market, usually how do you make money in the stock market? Does anybody know the basics of stock markets? How do you make money in the stock market? You buy shares, you buy like bits and pieces of ownership of a company, and then you let it grow, and then you sell it. And you make money. You bought it for $1, they went up to $2. Maybe you have like 1,000 shares, 10,000 shares, I don't know. But you sell those shares and now you make money. Dividends is different. Dividends is on top, like, so let's say you buy shares and it grows. But every year the company, like let's say Walmart, we sold so many millions of dollars this year. That's our profit. We're going to share some of that with our shareholders. That's called dividends. So they pay out every year. If they do well, they pay that out to you, which is income. That's income. Without you having to sell your shares, you're making money, okay? So that's pretty cool. Capital gains is how much you've gained. So I will just say here, this is the example. If you purchase something for $500 and you sell it for $900, capital gains is the $400. Let's do a bar example here. If you purchase something for $500, it gains $400. Right? This whole thing, you sold it for $900, but it's what it went up by. This is the capital gains. Oh, the bell's about to go. All right. I'm just going to let you off the hook today. So no homework.